Good day. I'm Martin Gago with Market Radius Research. It's Monday, November the 14th, 2022. We've got CEO Chris Dobbin of Nova Leap Health joining us today. Nova Leap is an acquisitive home care services company performing home-based continuum of care services, particularly dementia care. The company is geographically diversified with operations in 11 states and 1 province. Nova Leap just reported its Q3 2022 financial results, posting its second highest quarterly revenues and its best quarterly adjusted EBITDA. Chris is here to discuss the company's operations and review its Q3 financial results. But please remember, this is neither a recommendation nor investment advice. We're here to learn about the company. Chris, thanks a lot for joining us today, and please review the quarter for us.
Thanks for having me, Margaret. Yeah, I'd be happy to review the quarter. I mean, Q3 for us was a pretty strong quarter. We had our second best revenue on a quarterly basis ever, just over $7.1 million US for revenue. Our best adjusted EBITDA on a quarter basis, and our gross margins as a percentage of revenue continue to go up. So all in all, I'd say from a financial perspective, it was a pretty good quarter for us, particularly coming off Q2, which had been a little bit weaker. So the adjustments we'd indicated we'd made in Q2 are paying off, and Q3 was a strong quarter for us.
So what's driving the revenue growth over the last year? You have done some acquisitions. So can you flesh that out a bit?
Yeah, I mean, we're looking at revenue growth. I mean, quarter over quarter it was organic, and so that we had implemented a few things organically that we're testing out, and just had a good focus on organic growth in a quarter, and so that's where we saw the lift there. On a year-over-year basis, we did complete a number of acquisitions last year, in particular 3 in December of last year. And so that's where the disparity or the big jump would have come in from a year-over-year basis. But yeah, I mean, the acquisitions are going well, good organic growth within the quarter. So all in all, again, a pretty strong quarter for us.
All right, and you mentioned you had in the last quarter, in Q2 you said you were trimming some overhead costs. I don't think it's quite a restructuring, but just cleaning things up, I guess. Was that after sort of 6 months of digesting the acquisitions, figuring out where the efficiencies could be gained in the whole system?
Yeah, I'd probably describe it a little bit differently than that. I'd say really what we looked at was, because if you think about where we were pre-COVID, like things have been going very, very well. We did take a dip during COVID, as all the investors that follow us would know, and we're coming back out of that. And I'd say we had an expectation, certainly I had an expectation that the availability of labor would be better than what it had been, right? So I had an expectation that as a company, we'd still be growing along the same pace that we had been from an M&A perspective this year, as a result of having the labor pool. And that has been, up to this point, a little bit more challenging than what we anticipated. And so as a result, we ended up in a situation where I'd say our cost from an overhead perspective, a little bit higher than what I would have liked. And so given that we haven't done as many acquisitions this year, I just thought a rebalancing or adjustment was necessary. And so we did eliminate certain positions, more in support positions. Those were done in Q2. So really we had the benefit of Q3 of not having those positions in. And that's why you saw, quite a decline in the overhead cost, particularly at the head office level, which I think dropped down to about 3.7% of revenue, which is a really good number for us. So yeah, it was Q2 had indicated that we had made certain adjustments to the business. We did do that. And those adjustments obviously were from a financial perspective, worked out quite well for us in Q3.
Can you discuss because the biggest factor limiting your growth right now, I believe, is it still the availability of labor, and I guess tied with that is in inflation. Could you discuss what the market's looking like out there right now?
Yeah, 2 different questions. So from a labor perspective, I'd say in certain areas that we operate, it's come back pretty nice. I mean, we have businesses that are up significantly from where they were last year, and really that has to do with the fact that we have an increased availability of labor. I mean, there's a direct correlation. So that's been on the positive side. We still have some businesses that still struggle in some geographies to get as much labor as we would want, and so that's not allowed us to grow back as quickly as we would like. And so there's still a challenge there, but there's still, but I think we're starting to see a loosening of that. Now, I don't know if that has to do with, the economy as it exists right now, and layoffs that are happening in different sectors. It's hard to say at this point, but there does appear to be some loosening or an increased availability of labor in terms of some locations that we previously were really challenged in. So again, from us, that's a positive perspective. In terms of the inflationary question, that impacts in a different way. Oftentimes when you're in an inflationary environment, as we were particularly at the wage level, where everybody's consuming, you're competing for the same labor pool, we had to adjust wages. But in our business, where we're private pay, and we're not restricted, I guess, in terms of what we may be if we were Medicare or Medicaid in terms of a reimbursement rate, we were generally able to pass those costs on to our clients. And that's why, if you look back over the last couple of quarters for us, you've seen an improvement in our gross margin percentage. And so really it's the benefit of having a private pay type business like we do that allows us to maintain the margins or slightly increase them as we have over the last couple of quarters.
All right. This past quarter, you raised over $2 million in equity, largely from the from management and insiders. You're using that to repay some debt, as well as giving yourself a bit of a war chest for acquisitions. Can you talk about the acquisition environment a little bit? Like, you mentioned that you hadn't done as many as you were possibly thinking to do over the last year. What's the outlook for maybe the next 12 months in terms of acquisitions?
Yeah, look, I'll address the debt part first. Just the private placement, generally we're using for working capital and looking at expansion and M&A opportunities. So not really on the debt repayment side. We did repay a bunch of debt last quarter, but really that was from other sources. So the money that's being raised is really to continue on with our growth strategy. The insider participation was excellent. I think we had about 82.18% thereabouts participation, which certainly from my perspective is good indication to the market that we believe in a strategy that we've been pursuing and continue to follow. I think we've done an excellent job of insider participation over the last couple of years, last few years, really since inception. From an M&A perspective, I would say this environment's been a little bit more challenging, not from access to deal flow, but just given the capital markets. I mean, we've typically been in a situation where we've raised money and we've gone out and done deals and sort of repeated that process as we've moved along. The liquidity within the microcap and nano-cap space has been, has declined quite significantly. So I'd say we're much more cautious right now in the environment. So good thing is lots of deals, and there'll continue to be lots of deals going forward. We're still actively in discussions. So I know we're going to continue to make acquisitions. The question is just, when do those sort of happen? Last year we closed 3 in 2 weeks at the end of December. Who knows what will happen this year? Again, it's hard to say, exactly when something's going to close, but certainly we're having active discussions. And we do have cash on the balance sheet. And I think valuations in this type of environment tend to come back to a more normalized level, a little bit less competition out there, given the increase in interest rates and so on. So, good valuation metrics right now, lots of availability of deal flow. And then on the flip side, not quite as good as a capital markets environment as what we had, 18 months ago.
Well, I would think on the acquisition side, target acquisitions would also be sort of hit as well, given the environment. So giving some more better value on the purchase side.
I think from a valuation perspective, like we think about multiple, of EBITDA as an example, as a metric we use, I think there are attractive metrics out there for us as a purchaser. Whether or not the companies have done well or not, I think I've sort of looked at maybe 3 different buckets over the last couple of years of the home care agencies I've looked at. Some have not done as well. Some have been, on par with where they were pre-pandemic, and some have done better. And our portfolio of agencies is really a microcosm of that, right? We have 3, we have agencies that would fall under all 3 of those buckets. So that's generally what we see. So, our businesses we're looking for generally are small, good management teams in place that want to stay post-acquisition, a geography that we understand well, good client referral base, good caregiver base, typically in a rural area. So those are agencies that we really like, and we think we can continue to buy them at attractive multiples. So again, the environment out there for buying agencies is still pretty strong. The challenge is like the availability of capital to grow as quickly as what we would otherwise like.
All right. Well, I think that hits the high points on the quarter. Are there any things you want to mention before we wrap this up?
I think that covers it. I appreciate you having me on, Martin. I mean, it was again good strong quarter for us. I think we're in a good position going this year. The only other thing I'll say is probably from a debt perspective, we're in really good shape. We're paying down the ERC amount. Again, people understand that, follow us would understand what that is, and then we have very little bank debt that'll be remaining at the end of next year. I think to the tune of $265,000. So, from a debt perspective and a cash flow perspective, I think we're in a pretty good spot.
All right, Chris, thanks a lot for joining us, and thanks for the update. Cheers.
All right, take care.